fair value gains. Quarter two alone contributed SAR 474.7 million in bottom line profit, which is up 34% year over year. Footfall reached 66.5 million visitors for the first half of the year, marking a 7.9% growth year on year when you exclude Mall of Dhahran. Quarter two footfall was just about flat, but still showing positive momentum for the quarter. Importantly, we recorded a SAR 325 million net fair value gain on investment properties, driven by continued progress on our development program. That's SAR 149 million higher than half one last year and SAR 155 million more than quarter two 2024. Now, during quarter two 2025, CENOMI Centers launched its first consumer app called CENOMI Plus to build an engaged community with our mall visitors. The application achieved more than 900,000 downloads in less than 1 month, which is June this year, and has been ranked as the #1 lifestyle app in the App Store for KSA. We launched our second campaign for CENOMI Plus in August to continue to build on these numbers, and I'm happy to report that we now have over 1 million downloads of the app as of today. This app was launched June 1st of this year. More to come on this initiative later in the year, as we will be adding loyalty as well. Lastly, we completed the SAR 100 million sale of land in Al-Kaj, bringing total non-core asset disposals to SAR 1.2 billion as of June, which is aligned with our capital recycling strategy and our focus on our core assets. Now let's review our projects. To satisfy demand, CENOMI Centers is building a future that will lead to long-term investor returns and sustainable growth. We currently have 6 projects in the development pipeline. This includes our 3 flagship destinations, Jawharat Riyadh, Jawharat Jeddah, and Jawharat Al Khobar, as well as our 3 lifestyle destinations, Jubail Marina Mall, Yuwaq Qasim, and Murcia Mall. By 2027, this should lead to 559,000 additional square meters of GLA, which is a 46% increase over today. Over the next few slides, I'll share the progress of our growing portfolio, specifically discussing Jawharat Riyadh and Jawharat Jeddah. Strategically located in the western district of Riyadh with convenient access to major highways and urban centers, Jawharat Riyadh will become the capital's premier retail destination. It will have a catchment area comprising 65% of high-income households and 75% of mid-income households within a 30-minute driving distance. We are projecting 24 million visitors per year and a spend potential exceeding SAR 5 billion upon stabilization. Jawharat Riyadh will feature the city's first international standard luxury wing, a next-generation immersive and interactive central hub, unique world-class entertainment offerings, and 220,000 square meters of GLA split into 155,000 square meters of retail space and 65,000 square meters of prime office space. We are proud as a team that Jawharat Riyadh will be Riyadh's first Gold LEED certified mall. Jawharat Riyadh is now 98% structurally complete and 85% pre-leasing completed, based on heads of terms agreed, signed letters of intent, and signed lease contracts. Jawharat Riyadh will introduce more than 300 stores and more than 75 flagship stores. It is on track for delivery in April 2026. Jawharat Jeddah is set to redefine retail in the city of Jeddah. It is strategically located near key developments like the international airport, with 95% of high-income households within a 30-minute drive. We're expecting more than 18 million visits a year and a SAR of 3 billion more, or 3 billion plus, spend potential upon stabilization. Jawharat Jeddah, upon opening, will have 104,000 square meters of retail space, showcasing more than 300 stores, including 30 new brands to the kingdom and 50 flagship stores. Jawharat Jeddah will feature Jeddah's first international standard luxury wing, next-generation entertainment and event hubs, and 3 distinct experiential F&B zones. It will be the first Gold LEED certified mall in the kingdom when it opens. Jawharat Jeddah is now 99% structurally complete, and pre-leasing is close to 92% complete. Upon full stabilization in 2029, Joharat Riyadh and Joharat Jeddah are expected to contribute over SAR 650 million to our EBITDA, which is 40% of our current EBITDA today. On the next couple of slides, you'll see some renders. This is Joharat Riyadh from both the inside and the outside. And next is Joharat Jeddah. And the team and I are incredibly excited to bring these really stunning malls to the kingdom in the near term. We announced the Unibail-Rodamco-Westfield partnership in May 2025. This partnership was a natural fit as Westfield is the #1 mall developer and operator in Europe and the US, and CENOMI Centers is the undisputed #1 mall developer and operator in Saudi Arabia. The partnership entails 20-year exclusivity in Saudi Arabia, with 10 years initially and an option to extend for an additional 10 years. Up to 8 CENOMI Center flagship assets will be rebranded as Westfield, including Joharat Jeddah, Riyadh, and Nakheel Dammam. Over the next 12 months, they will now be known as Westfield Jeddah, Westfield Riyadh, and Westfield Dammam. As a part of the deal, Unibail-Rodamco-Westfield will provide continuous support to our team and upgrade CENOMI Center's capabilities. This includes asset audits and business plan reviews, on-site support and hands-on training, as well as manuals and tools. And I can attest that many of these work streams are already underway. In addition, CENOMI Centers now receives access to Unibail-Rodamco-Westfield's international tenant network, including top luxury brands that are not yet present in Saudi today. So now let's take a look at the operational overview. When looking at some of our key performance indicators, footfall continues on its upward trend. And for the first half of the year, we saw total footfall rise to 66.5 million, up from 66 million in H1 2024. But when excluding Mall of Dhahran, footfall actually rose 7.9% on a like-for-like basis year to date. We're maintaining our guidance for 2025 occupancy at year-end to be between 94 and 95%, reflecting the sustained appeal of our malls as premier shopping and lifestyle destinations. Our GLA stands at 1.3 million square meters and occupancy rates were broadly stable at just over 92%, with average monthly occupancy growing by 0.4% in the first half of this year over the first half of 2024. And during the second quarter, we welcomed 22 new brands, comprising of a mix of fashion and accessory, food and beverage, perfumes and cosmetics, entertainment, and department stores. Among these additions, we saw distinguished names such as Hollister, Abercrombie & Fitch, All Saints, Dua Al Mualim, Jewelry, and Al Falah. We renewed over 1,100 lease contracts in the first half of this year, and many under more favorable terms, which is a clear reflection of our focus on operational excellence. Our disciplined renewal strategy is designed to align with the evolving Saudi consumer and their preferences while continuously improving the quality of our tenant mix. Notably, around 2/3 of these leases that are expiring this year are in Class A malls, which gives us a strong opportunity to further enhance the portfolio. We continue to be very proactive with our leasing activity to extend the tenure of our contracts beyond 2027, thereby increasing visibility and predictability of our earnings. And the weighted average rental revenue per square meter continues to increase. In H1 2025, it increased 2% to SAR 2,040 per square meter when compared to H1 2024. We've also de-risked our top line through low-key tenant concentration. You can see on this slide how we have renowned franchise partners in the region, like Landmark Arabia, Leather Corner, which is apparel group, Kamal Jamjoon, and Farouk Group, aka Shaloub, which are more or less stable or growing in rental revenue and GLA. And we continue to have CENOMI Retail as a key tenant, but its contribution decreasing in rental revenue and GLA. In fact, CENOMI Retail GLA dropped from 161,000 square meters in December 2024 to 156,000 square meters in June 2025. CENOMI Retail rental revenue in SAR also continues to decrease. The Inditex brands have stayed broadly stable and strong over the last 6 quarters. However, rental revenue from non-Inditex brands has decreased significantly, which is down by 7% year on year. CENOMI retail occupied GLA has seen a similar trend. While Inditex has increased modestly, non-Inditex has decreased 6% in the last 4 quarters. We were also pleased to see in July, CENOMI Retail's announcement of the signing of a share purchase agreement between its founding shareholders and Al Futtaim for the sale of a 49.95% stake to Al Futtaim. As per the announcement, Al Futtaim and CENOMI Retail are currently negotiating, as part of the SBA completion conditions, entering into a shareholder loan agreement for the provision of an amount not less than SAR 1.3 billion. We expect that such a transaction will result in addressing the overdue payments to CENOMI centers and will eventually result in resumption of rental payments going forward on a timely basis. Now, let's shift gears. We will look at a detailed financial update, and I'm going to hand it over to Jabri.
Thank you, Alison, and good afternoon, everyone. Now, moving to the financial update, starting with our top line. We have had stable top-line performance across the portfolio. The steady growth was supported by strong performance across all revenue streams, despite the absence of the contribution of Mall of Dhahran. During the quarter one, we reached a revenue of 583 million compared to 587 million in quarter 2 2024, with a slight decrease of 0.7% year over year. Due to the absence of Mall of Dhahran contribution, net rental revenue and media sales show a decrease compared to 2024. However, this increase was offset by the increase in other revenue streams, including variable rent. Excluding the impact of Mall of Dhahran, the revenue from existing portfolio, in fact, has increased by 7.2% in quarter 2 year over year. As you can see from the revenue bridge, over the year, we saw a growth in existing portfolio of around 6.9%, approximately around 73 million Saudi riyal. And this is mainly coming from rental improvement, steady occupancy rates, and improvement in non-GLA revenue. That was offset by the reduction from Mall of Dhahran, around 52 million, resulting in a flat top line of Saudi riyal 1.173 billion. Before I walk you through the next 2 slides on cost and profitability, I want to flag that comparative period was impacted by certain reversals. I'll highlight these as we go to ensure we are looking at the actual performance on a like-for-like basis. So starting with the cost of revenue, while the reported numbers in 2025 show a reduction in the cost of revenue by 7.7 in the 3 months and 13.8 in the 6 months, the comparison was impacted actually by certain provisions booked in the comparable period during 2024, which were reversed actually in quarter 4 2025 at the end of the year, which has make the numbers are not directly comparable. After adjusting of this, the cost of revenue in fact decreased by 1.5% in the 3 months and 6.3% in the 6 months, and this is which is are in line with the cost control initiatives which we have started in 2024. On our G&A expense, for quarter 2 show a slight increase of 2.8% year over year, and this is mainly driven by the increase in professional expense. As for the 6 months, 2025, the increase was driven by 2 main factors. First, higher spending on government and professional fees. And second, there was a reversal of staff-related provisions amounting of around 9 million in the comparative period. And after adjusting for these one-off reversals, the year-over-year increase in G&A, in fact, it's 9.5%. And the same on the EBITDA, these one-off and reversal has impacted also the comparative numbers. So if we look on, as what you can see, the EBITDA in the quarter decreased by 8.8%. To 360 million. The decrease actually mainly is driven by the increase in the impairment losses on accounts receivable, which we booked during this quarter. In the H1, in the 6 months, the stable revenue, the reduction in the cost of revenue, and the increase in our on the other operating income has maintained the EBITDA level at 718 million, which is in line with the last year and despite the absence of Mall of Dhahran. However, by excluding Mall of Dhahran and compare like for like, the existing assets has grown. The EBITDA in the existing assets has increased by 4.9%. On the net profit, the quarter saw an increase of 34% year-over-year, and this is mainly driven by the increase in the gain from the fair valuation. And the same in the 6 months, the 29% increase year-over-year. This is mainly driven from stable EBITDA and also the increase from the gain from the fair value gain. And the fair value gain, just to highlight the increase in this quarter and actually in the 6 months is mainly driven by the significant progress that we have in Jawharat Riyadh and Jawharat Jeddah. So in the fund from the operation, the 6 months show a 379 million in fund from the operation with an increase of 2.1% compared to the previous year. Moving to the balance sheet, we have a strong balance sheet. As of June 2026, we have a total assets of 32.5 billion with an increase of 3.4%. This increase mainly reflecting the increase in the investment properties following the capex spending on development projects and as well as the increase in the fair value of the assets. Our cash has reduced from 670 million beginning of the year to 238 million, and this reflects the utilization of the cash to support the development projects, Jawharat Riyadh and Jawharat Jeddah. Our equity has increased by 2.3%, stands at 15.2 billion. And on the debt side, as you know, as we progress on our development projects, our net debt has increased by 6.5%, reaching to 12.25 billion. We will walk you through more details on our debt and the maturity profile in the next slide. So moving to the debt. On the right side, it shows the breakdown of our debt. This includes Islamic facility of 5.3 billion, non-recourse debt of 1.39 billion. These are related to Jawharat Riyadh and Jawharat Jeddah. These facilities to support the construction of these two projects. Then moving the Sukuk proceed. This is two issuance maturing in 2026 and second one maturing in 2029 with total amount of 5.9 billion. reducing the cash that we have in the balance sheet at the end of the period, bring us to a net debt of 12.25 billion. The breakdown of our debt is split between secured debt at 52% and unsecured debt at 48%. And our average cost of debt stand at 7.2% as of June 2025. On the chart on the right side, it shows our debt maturity schedule with no repayment obligation until 2027. This is important because by 2026, Jawharat al-Riyadh, Jawharat Jeddah will be completed. Hence, there is no material repayment obligations until these assets contribute to the portfolio. Our next significant repayment is in 2026 with 3.3 billion. This is related to 2026 Sukuk, which is maturing in October 2026, 15 months from now. Just to highlight on our refinancing plan, our refinancing plan remain unchanged. We are progressing well in the local Sukuk program. Now we are in the final stage with the CMA approval. We expect the CMA sign off by end of August, maybe mid of September, which will allow us to access the local market by then. Our first issuance will target around 750 million Saudi riyal. This will be utilized to buy back a portion from the 2026. And in parallel, we will move ahead with the new USD issuance. We expect both transactions, the local and the USD, to be concluded in Q4 2025. Moving, just to give you a highlight of an update on our investment properties. As of June 2025, the fair value of our assets portfolio stands at 28.7 billion. This is broken down by 12.5 billion in freehold assets and 7 billion in leasehold assets. These are assets we own but built on a leased land with an average expiry profile of around 11 years. The third component is the 9 billion is land and projects under construction. These are mainly Jawharat al-Riyadh and Jawharat Jeddah, plus the other few projects in the pipeline. Just to highlight that these assets, Jawharat al-Riyadh and Jawharat Jeddah, as what we discussed before, these are structured under a separate fund, the real estate fund. However, we consolidate these assets into our balance sheet. On our NAV per share, our NAV per share has grown by 5.9% this period, standing at 32 riyal per share. On the dividend side, our dividend policy reflects our commitment to our shareholders. The policy remains unchanged. Since 2019, we have delivered semi-annually or quarterly distribution, providing shareholders with an attractive yield. Our approach continues to be guided by the same principles of delivering sustainable returns in line with our capital management priorities. Now, the following slides, we will outline our guidelines, our guidance for the year. We are expecting 1.3 million square meter of GLA by the year end, which is slightly lower than 2024, which was 1.4 million square meter. And this is the reflection of the handing over of Mall of Dhahran. Excluding Mall of Dhahran, our occupancy is expected to be approximately in the range of 94 to 95 compared to 95 1.4% at the end of 2024. The revenue is expected to be flat at 2.3 billion. As mentioned earlier, we expect some losses on revenue from the handing over of the Mall of Dhahran. However, this will be offset by an improvement in rental rates and an increase in revenue from media sales. And this is actually, we have witnessed this in the 6 months where we are flat compared to the previous period. The adjusted EBITDA is expected to increase to around close to 70% versus 63.9 in 2024. This is reflect our focus on operational efficiencies and profitability enhancement. And this is just a bridge to show you how we are planning to maintain our revenue flat despite the absence of Mall of Dhahran. So the key factors in revenue, we have the loss from Dhahran. We will have a loss from Dhahran around 139 million. And we anticipate to offset that partially through multiple factors. First, from the UWalk Jeddah, as we expect to contribute around 32 million in the revenue as the site continue to ramp up. Additionally, like-for-like improvement in occupancy and lease renewals will add around 50 million, reflecting actually our focus on optimizing tenant mix and maximizing rental income. We also anticipate 10 million in incremental turnover rent, benefiting from the stronger tenant sales and from the non-GLA revenue, including media sales and other ancillary income. We are expecting to generate around 48 million. Adding all these together, these factors will lead us to an estimated FY25 revenue at 2.3 billion, in line with the prior year levels. Moving to update you on our CapEx budget and the funding of these requirements. Our capital structure is well balanced and supported by various ranges of funding sources. And while there will be a temporary liquidity constraints this year, as we are in the final stage of our peak OPEX spend, the company remains financially stable. Our budget for 2025 is planned to be at 2.6 billion. The bulk goes towards Jawhar Riyadh and Jawhar Jeddah. To date, we have spent around 900 million on the two flagships, with 1.7 billion remaining for 2025. In 2026, our budget is expected to be at 1 billion, which will be used to develop the remaining projects in the pipeline. As per our funding strategy, our investments are funded by mix of assets, disposal, equity, and debt. So as what you can see in this slide, that the remaining CapEx for 25-26 to complete the projects in pipeline is around 2.7 billion, which is 1.7 billion in 25 and 1 billion in 26. How this will be funded? This will be funded through the cash on our balance sheet. This is the cash plus the money market that we have it in our balance sheet. 800 million is the remaining undrawn facilities. Mainly this is Jawhar Riyadh and Jawhar Jeddah. 600 million, this represent the advances that already paid to the main contractor. This will be utilized or depleted during the construction period. And as well, the remaining disposals as part of our non-core asset program, which we will highlight in the next slide. So moving to the non-core asset program, We have made strong progress in this program. We have unlocked approximately 1.2 billion to date. The last transaction was in this quarter, which is Al Kharj land, a piece of land in Al Kharj city. We have sold this at 100 million. About 800 million remains in the program, with the majority is expected to come from the Al Qasim land. This is a large piece of land in Al Qasim, plus some other small plots, expecting to generate around 800 million over the next 12 months, in line with the progress of our projects in the pipeline. So by this, that's all from my side. Now back to Alison for closing remarks.
Just in summary, we believe that we've had a strong first half of the year, especially in light of Mall of Dahran. I'm actually been quite pleased to see the metrics on a like-for-like basis, excluding Mall of Dahran. And of course, we're always happy to see the uplift in valuations when it comes to the two projects, Jawharat Riyadh and Jawharat Jeddah, which will be game changers for this company in 2026. So, without further ado, we're happy to open it up for questions.
Thank you, management, for the presentation. Ladies and gentlemen, now we open the floor for Q&A. Please limit yourself to 2 questions, and to ask a question, you can click on hand raise button, or maybe you can use the chat box to post your question. We will give it a minute. Okay. I can see one hand raised. This is Dimitri. Please unmute yourself and go ahead, Mr. Dimitri.
Hello, just checking. Can you hear me?
Yes.
Yeah, thank you very much for the presentation. Very helpful. Just two questions from my side. The first question would be on two projects, GGNGR in your pipeline. I think the new timeline assumes that this project will be launched in 2027, right? And previously you guided for first half of 2026. Can you kind of elaborate on the new timeline? Why you expect these projects to be launched later? What were the main factors that contributed to the delay? And also a related question about your EBITDA, which you expect to be fully ramped up at 650 in 2029. How should we look at the EBITDA from these projects in the next few years? I understand this EBITDA will be in 2029, but how should we look at EBITDA in 2027, 2026? If you could guide us, would be very helpful. So this is my first question, and the second question would be on your sale proceeds. You mentioned you targeting 900 million in sale proceeds from non-core asset sale. What is your plan B if there are any delays with the sale proceeds? How can you finance the breach, because you need this 900 million in sale proceeds? Do you expect to raise additional secured financing? Do you expect maybe to raise another loans just to breach this financing gap, because these proceeds are quite important? So this is my second question. Thank you very much.
Sure. Hi, Dimitri, it's Alison. I'll take your first question, and I think Jabri will take the second question. So, on the J's, we put the development slide back up. Maybe it was in my delivery, I'm not sure, but there seems to be some confusion. We are still delivering these assets to open in 2026. We've got, Westfield Jeddah, I shall call it. At the moment, it's still scheduled for December 2025, which means full operation in 2026. And Westfield Riyadh will be opening in April 2026. So both will be contributing to EBITDA in 2026. You can, to the second point of your question, when it comes to EBITDA, it takes 3 years on average for a mall to stabilize. So when we say 2029, it's because I'm taking that 3-year term of 26, 27, 28, let's say beginning of 29, when we've realized full stabilized EBITDA for both assets, which we are projecting will be 650 million SAR, which is about 40% of our current EBITDA today. So if we were to just think about, a mall needs to ramp up over a 2 to 3 year period with occupancy rising over that same time period. So, Jabri might be able to answer this a bit more articulately when it comes to what we're expecting in 26 and 27 and 28. But you can imagine that if you're opening malls in 26, you're not obviously receiving full EBITDA in that year, and your occupancy is still ramping up. I'll let, actually looking at Jabri, I'll let you answer at least what I think we're projecting in 26. I don't want to throw out a bad number.
Yeah.
And maybe 27, just to give you some guidance. But we haven't changed the timelines actually, even since our presentation last quarter.
Okay, that's helpful. And if you can guide us on EBITDA progression, like ramp up, that will be helpful.
Yes, sure, Dimitri. Again, this is maybe we can share some numbers after the presentation, but usually, as what Alison said, that the contribution will start from the opening. Once we start opening, there will be in part. So there will be a portion that will be in 2026. Of course, it will be in the low side because you need to consider the occupancy rate level. You need to consider the timing of the opening. Then at 27, the contribution will be higher till it's reached to the stabilized phase. The stabilized phase, we consider it when the occupancy reached to 90%. In terms of the numbers, this is usually we are not providing these guidance, but I'll try some numbers that can be shared. So the second question about are you okay? Shall we move to the second question, Dimitri?
Yes, if possible, if you could elaborate on alternative financing options for you, if it is SSLs are delayed, that will be helpful. If you can probably maybe update us on any alternative options like secured financing, because you have some unencumbered assets and etc. So basically, any plan B for at the moment, that will be helpful. Thank you.
Again, as what we see here in this slide, that we have 800 million that it's the remaining in the asset sale program. In fact, based on the progress that we did in the sale, in the disposals, and based on the recent transaction that we did, we believe, we are confident that we will be able to finalize this program in line within the next 12 months, which is in line with the development plan that we have. And as I have highlighted, that the majority of the 800 is coming from Al Qasim land. Al Qasim land, this is the land is ready for sale, and this is we have moved these assets to a real estate fund, GIB Capital. They have their connections with the developers, and the main purpose from moving this land to the fund is to facilitate the sale of the land. So we expect the proceeds from this land to start materialize within this 12 months. In case of any delay, the other options are available in terms of accessing, let's say, additional funding or additional facility. But currently, it's nothing being decided. We are confident that the disposals will be concluded given that we have achieved as of now around 1.2 billion out of the 2 billion. So and also to highlight that the focus now is on Jawharat al-Riyadh and Jawharat Jeddah. So even if there was a delay, a partial delay in the disposal, the remaining sources will be sufficient to complete Jawharat al-Riyadh and Jawharat Jeddah within the timeline that we have highlighted.
That's very helpful. Thank you very much. And just a quick follow-up question that just related to this sources and uses slide. When it comes to remaining capex of 1.7 billion for this year and 1 billion for 2026, how flexible are you around this capex? So, for example, can you, for example, delay some of the capex for this 2020 into 2026 or cancel some of the items? Because as you correctly mentioned, this liquidity might be stretched, and do you have any flexibility around capex for the remainder of the year in 2026? So that's the last my follow-up question. Thank you.
So part of the capex, the remaining capex for 2025, there's 300 million for Khobar project. What is this one? Still, we have flexibility actually on that project. Another point, maybe just to highlight that our main contractor is
Links.
Links. This is one of the related parties. Links, they are the main contractor for us. They build all our malls, almost 21 malls. So we have flexibility actually with Links in terms of let's say in terms of the payables, the payments for the main contractor. So in case we have some delay, we can rely also on Links on that.
Thank you very much. That's clear. Thank you.
Thank you. We now move on to the next participant, Nandini. Please unmute yourself and go ahead. We can't hear you, Nandini. Please unmute yourself and go ahead. Okay, we will move on to the next participant, Ankir Richter. Please unmute yourself and go ahead. Richard, can you? Hello? Team CENOMI, can you hear me?
We can hear you.
Yeah, I think there's some problem with. Okay, we can move on to next participant, Abhishek Shukla. Abhishek, please unmute yourself and go ahead. I'm not sure why this voice issue is there. I believe you, CENOMI team, can hear me.
Yes.
Yes, we can hear you. Yes.
Okay. Meanwhile, we take a question from chat box. So this question is from Mr. Sadeem. He's asking for Jawharat Khobar. Previously, you mentioned that this asset would replace the Haran Mall, but now opening is TBD. So how do
Yes.
you plan to offset the loss? Especially the new mall location has a lot of competition around this.
Okay, so first of all, Jabri went through a very detailed slide about how we're making up the difference of Mall of Dahran earlier. So hopefully that was paid attention to. And then, of course, in 2026, we have these two new malls opening, which is Westfield Jeddah and Westfield Riyadh, which will obviously compensate for the loss of Dahran. Khobar, yes, the competition is there. One of the key points, and I think I mentioned this in the Q1 presentation, is that we are having ongoing conversations with a couple of the schemes that are adjacent to us. One specifically being the Saudi Downtown Company, which is a PIF entity that's building downtowns across 12 different cities in the kingdom. This happens to be adjacent and across the street from our piece of land. So the conversations have actually, if I may, they've gone quite well in terms of ensuring that we are aligned, potentially partnering, and are synergistic in what we're going to build to avoid an over saturated situation in that specific area. So I am hoping, to potentially announce what we're going to be doing in that part of the kingdom later in Q3. That is at least the goal. If it's not later in Q3, hopefully by Q4, and then everything will be much more clear.
Okay, thank you. I think we have Nandini back in the queue. Nandini, can you please try unmuting us?
Hi, am I audible right now?
Yes, you are. Thank you. Go ahead.
Okay, sorry about earlier. Thanks for taking my questions. My first question is regarding the bond refinancing plan. Not sure, sorry, I missed the call for a few minutes previously, but just wanted to understand what's the reason for the delay in receiving the CMA approval. I think we were expecting it by mid-May, but now we're talking about end of August. So, and also just a quick clarification there, are you still looking to raise 2 tranches of SAR bond or just one? That's the first question. Should I go with the second question or should we do one after the other?
Maybe let me just go through the first question. Again, as what we said, our refinancing plan has remained the same.
Yes.
There's no changes. We are targeting to have the Sukuk, the local Sukuk program, and as well as in parallel, we will go for the international. Now, for your question, why this took a long time, this local Sukuk is it's a process that similar to the IPO, because this is it's a local and it will be a public issue. So there's a lot of requirement in terms of the disclosure and the documentation. All the documentation need to be done in Arabic, and then be translated to in Arabic. So there are some terms that it might take, let's say, time. And if you remember last year also, there was a change in our update in the regulation and the disclosure regulation by CMA that has required additional, let's say, update and work on the Sukuk. However, we have completed multiple submissions to the CMA. And now we are in the final stage in terms of the sign off from the CMA. So we expect, as what we mentioned, by end of August, mid of September, that the program will be established and ready to start. So this is for the first question.
Thanks so much. So I'm just a follow-up as if I understand it correctly, once you get the approval, you should be coming to the market within a week's time, not months' time.
This is, this is a program. So the size of the program is 4.5 billion Saudi riyal. Of course, we will not go to the market for the full size. The plan is to target around 750 million Saudi riyal, equivalent to around 200 million. This is to buy back a portion from the 2026. Now, the validity of this program is 2 years. So once we have the approval from the CMA, we have around 6 months to first transaction. After that, the program will remain valid for 2 years, so we can do multiple tranches after that.
Understood. That's clear. Going on to my second question, Just on the CapEx, I already see that the payment terms were extended for the construction, the links contracting company in this quarter, and even the CapEx spend of 400 million in the quarter is lower than the run rate, I think at around 700 million for the year. So wanted to understand that were there any issues in accessing the non-recourse facility or any other reason why the CapEx spend was lower or payable terms are extended? And if you further plan to extend payable terms as Plan B, which you were talking in the first question, do you think that the construction company would then be need to raise debt at their entity, or you see further flexibility to postpone the payments? Thank you.
The point about Linux and the flexibility, this is just one of the, let's say, the alternatives that in case that there is a delay in progressing in the non-core asset, in the disposal program. However, now, as what you can see from the screen here, we have, for the 6 months, we have spent almost around 1 billion, which is 900 plus, this is already spent. And this is in line actually with the development plan and the progress. So this is based on this spending, our expected timeline, the projects has not changed. The 2.7 million, which is the remaining capex for 2025 and 2026, it's almost fully funded, as what you can see here in the screen. We have 500 million in cash. This is two parts actually. This is the cash which we have in our balance sheet, which is around 240 million, and also we have a cash collateral, which is it is in the fund. This will be utilized in a later stage of the development. This is cash actually, but this will be utilized, available, but it will be in a later stage, in the final stage of the development. The facility, this is undrawn facility. There's no restriction on that. This is, this will be, this is a project finance, so it's based on the progress and in the project. So it will be partially drawn as long as we are progressing. The 600, this is actually cash already paid. So this is cash already paid. We will utilize this also within the progress. The last point is the remaining disposal, the 800. Here in this point where I highlight that if there is a delay, we will have a flexibility with the main contractor. This is if we need to that, if there was a delay in the disposal program.
Understood. Just a quick follow-up before I'll join back in the queue is, so the undrawn facility, the project financing facility of 0.8 billion, do you expect to fully utilize it by end of this year?
It's linked with the progress, in the project. And so Jawharat Jeddah, we are expecting to finish by the end of this year. Mm-hmm. So yes, the portion that's related to Jawharat Jeddah will be utilized. Jawharat Riyadh, it might extend to the Q1 2026. So it's linked with the progress in the construction.
Thank you. We now move on to the next participant, Anke Richard. Please unmute yourself and go ahead.
Yeah, thank you very much. Hope this works now.
Yes.
Perfect. Your cash position has stayed pretty much stable between the first and the second quarter. Clearly, you're going through a CapEx program. There's no cash flow statement. Could you probably outline what kind of were the bigger movements? How come the cash position stayed stable? Then also, you just outlined, how you're going to fund the CapEx program. But obviously, you need some cash to run the business. You can't run like on zero cash. So how much do you reckon you need to have as a cash position to run the business? And then you mentioned the undrawn facility. Are there any covenants or anything in there? And also, if you're planning to come to the market, is that secured, unsecured? And I believe there's somewhere a covenant which limits the secured funding, but maybe you could help me to refresh my knowledge on that one.
My suggestion is you try to condense your answers since that was quite a bit.
I will try in the third quarter call then.
Thank you.
Okay, for
Look, I think Jabri can give an abbreviated answer at least to some of Anka's questions, but it was quite a bit and we're almost out of time. So I'm going to leave it to Jabri to close with the last answer and then we.
Exactly. On the cash flow, I think we do not upload our financials in the website. However, it will be uploaded, I believe, in the coming 2 days. It will show you that we have a positive movement in the cash flow, and this is actually, if we compare it with the previous period, this is actually it's coming from there's an improvement in managing the working capital itself and managing the payables, and as well also there is also enhancement in the collection, despite that we have increase in some balances related to in the related party. So we have the cash that is required to run the business, and that's what we mentioned here in terms of the funding. The funding is for the project is already fully funded, as what you have seen here. So this 500 million, this is cash that we have it in the balance sheet. 300 million out of that, it's a cash collateral. It's already there in the fund, under one of the funds, Jawarat al-Riyad. The 800 million is facility. Back to your question in terms of the covenant, we are fine with the covenant. We have no restrictions on so far on the covenant. The 600 million, again, this is already paid. Yeah, this is cash already paid, so it will be utilized. So the fund that's required for the development is already pre-funded. Our operating cash flow to run the business and the operation, we have a sufficient fund that required to manage the operation, and you will see this in the cash flow statement. You will see the positive movement in the cash flow and the cash flow statement once we upload the financials.
Okay, thank you. I think we should take 2 final questions from the chat box before we wrap up. So one question is related to the debt issuance. With appointment of Rothschild, can your refinancing plan change? And related to that is, what if SAR issuance cannot materialize? What's the alternative refinancing plan? So this is related to the debt refinancing. And shall I read out the last question as well?
Let me just brief you on this. So on the refinancing, as what we said, our financing plan has not changed. The appointment of Rothschild, yes, we have appointed them as a debt advisory. This is to help us and support us on our financing activity. We need to consider that Sukuk, the majority of the Sukuk is in October 2026. We believe that we have sufficient time to do refinancing. It's 15 months from now. However, we are proactively started the process, the refinancing process. We have started the process of selecting the book runners to start accessing the market. The Sukuk, the local Sukuk, as what I said, it's in very advanced stage. We are in the final stage to get the approval from the CMA, And all these, both the Saudi Riyal, the local sukuk, and the international sukuk, we are targeting to start this or to conclude this in Q4 2025.
You know, we've got full confidence that we're going to be successful with our plan. But to answer the latter part of that question, you know, we also have access to capital through the banks. But we just don't foresee needing to go that route. And I'd like to leave the answers there for now.
Thank you so much. The last question of the day is related to the ECL. So with this Al Futtaim deal, is there any chance of provision reversals that we have booked so far?
There's a potential.
Yeah, there is.
Okay. With that, I hand over mic to the management to conclude the call.
Sure. Listen, thank